When you sell an investment that has grown in value, you'll get charged capital gains tax. But there's a way to maximize your earnings and send less of your money to the CRA. Joining us this morning to show us how is Peter Cishecki from Everything Financial. Good morning. Happy Wednesday to you, Peter.
Happy Wednesday, Keri. Good to see you.
So, yeah, capital gains, great to earn. Even better if you get to keep all that money and don't give all of it to the CRA. So what classifies as a capital gains? What kind of things are we talking about here?
Well, the most common one would be property. Say you have an investment property, a rental property, and you purchase it for one price, $250,000, $300,000, whatever the case may be, and it grows in value, and then you sell it. The profit on that is considered a capital gain, and the capital gain is 50% of that property. So if you made $200,000, you're going to have a $100,000 capital gain. And the other most common one, of course, is investments that are in what's called taxable or non-registered accounts. So not RSPs, not TFSAs, but you have these investments and the portfolio manager, the mutual fund company, whoever it may be, is selling things, buying things, etc. And so when selling things, you earn profit. Hopefully, that would be a capital gain. Or if you need to take money out, you've made a bunch of money and you need that money for other things, you cash in some of that money, there's profit, that's a capital gain.
Mm-hmm. So you have to claim this capital gains on your tax return. So how do you go about saving and keeping as much as you can of that and not sending it to the CRA?
Well, here's a good thing. There's three deductions really you can use, well, four deductions you can use against capital gains. One would be capital losses. So unfortunately, if you've lost money in the past, but I'll get into that in a second, you can use that one to your advantage, actually. The other one is RSPs. Put an RSP, if it's a $50,000 or $20,000 gain and you have $20,000 of RSP room, put $20,000 from that profit into your RSP to offset the gain. So the deposit to an RSP can offset the gain. So you actually keep all the money. It's just some of that profit goes into RSPs to be used at a later date, or else RSP equivalent deductions. And we've talked about this on the show before, which would be carrying charges or interest on a non-registered investment. Those are treated the exact same as an RSP on the tax slip. So anything you can do to keep the money, even if it has to go into a different account, to not give it to CRA is a good thing because you retain your profit.
You can move things around and see if you can hang on to that. Okay, you're going to tell us why the age of 71 is so important. Other than that, it's probably a fabulous age.
It's a fabulous age, I'm sure. But why it is so important in this? Well, we just hinted RSPs. So you can still buy RSPs up until that age. So look at your accounts. Your accounts should be reviewed every year for capital gains. Don't wait for the capital gains in an account to grow to some astronomical amount that you're forced to pay the money in tax. So really do an account evaluation before you turn 71 while you still have RSP room and still have the ability to deposit money to RSPs. Because imagine having a $200,000 or $300,000 capital gain, and this is actually a true story, and you also have though a couple $100,000 of RSP room still that you never used. But oh, wait a minute, you didn't evaluate your accounts, you didn't create those capital gains, and you're now 74 or 75, and all of a sudden there's nothing you can do except write a check to CRA, where all you had to do was stay in touch with your registered financial planner, look at evaluating your account every year, and take care of those gains every year instead of letting them grow to some amount that you're forced to write a check to the government. And writing a check to the government, Keri, is never a good thing.
No, I'm sure it hurts. It hurts.
It's very painful. You don't want to do it.
Yeah, indeed. Okay, Peter Cishecki, Everything Financial. Thanks so much for your advice this morning.
Thanks, Keri. Have a great day.
You too.